growth and activity in the world economy has been more robust this year than I think we would have probably been expecting if you and I had been having this conversation back in the spring. Now, alongside that, though, I think we have seen a number of developments which are the things that we're focusing on. And just to quickly run through them, I mean, we are seeing stretched valuations in some equity markets, particularly AI-related companies, particularly in the US markets. Now, I would say, look, I think it's important to put this into perspective. I think and hope that AI is going to be the next sort of, in a sense, source of what I call sort of dial-moving productivity growth for all of us, because we need it. And that's what really drives living standards. But of course, it is quite possible that markets have to value this future stream of returns, and they could overvalue it, clearly. So we have to watch it. It is concentrated, very concentrated in a number of companies. Those companies do have their own cash flow, as it were. But it's something we have to watch. The second thing I would draw out is the world of private assets, which has grown very rapidly. Private credit, private equity. And there, I think we're at the stage of having to do a lot more work to understand just how this area is developing. We've announced today that we're going to do a further what we call system-wide scenario exercise to test it out. So that's the second one. I would particularly focus on as an area that I think is something that has to be examined in terms of the overall financial stability situation in the global economy. Another one is the development of alternative payment mechanisms and stable coins. We're looking very carefully at how that will emerge. So again, an important one. The fourth and final one I would draw attention to, which we had before, is the extent of leverage in markets, particularly government bond markets, which has changed dramatically over the last 5 years or so.
When we take the totality, the thing that struck me this morning was this idea of the interconnectedness, if you will, the spider's web of many of these AI companies, and the way in which you now have got this circular financing that's taking place. Because what basically you're saying is, if there is a fall or if something slips over, then it will mushroom and will get worse. Now, I wonder, are you concerned that there's an opacity now to all these transactions and to the way these interconnectedness is working that does reminisce of 2008, 2009?
Well, I think two things. You're right that there is growing interconnectedness. Now, that's not surprising in some ways, because these business models are built on quite heavy levels of connection, because some of them are at sort of one end of the sort of production cycle, and the others are at different ends of that production cycle now. But it is growing, I think, so we have to watch that. The second thing is that, I mean, in some ways, naturally, they are moving from being financed out of cash flow to debt financing, and the debt financing is growing very rapidly as the investment demand grows very rapidly. Now, again, I don't think there's anything surprising about that in abstract, but I think we do have to look very carefully, because the scale of it is very big. On the other hand, of course, that is actually how we will get stronger productivity growth if this all comes to pass in ways that we hope it does.
To those of us of a certain age that remember dot-com boom and bust, and then go on to remember
Indeed.
GFC, I guess,
yes.
Are we is this report a canary in the mine? Is it an early warning that we have time now to put right errors, or at least imbalances that you're seeing, and that now is the time to do that?
Well, I think there's a number. You're right, and I mean, you and I, Richard, have been around too long, but we both remember both of those periods. And look, there are various elements of those periods that I would point to, as you do. One, in the dot-com period, I mean, there were companies coming in which had had stretched valuations and almost no cash flow. Now, we're not seeing that at the moment, but we went through that period with one thing leading to another. So that's why I think we have to be onto these issues and looking at them very carefully early on. If we go to the financial crisis, it's very interesting. And here I would look particularly, one of the things that I say to my colleagues a lot is, before the financial crisis, if you look at the US subprime mortgage market, We spent a lot of time looking at that and concluding it wasn't big enough to be a global threat to financial stability, and we were wrong. Ex post, you can look back with benefit of hindsight and say, well, you know, the default rate in the US mortgage market, yes, it went up, but it wasn't that high. But in the middle, we had a financial crisis. So what happened? Now, one of the things that happened was that we had a loss of confidence in the markets. We had complex repackaging of instruments going on, which I think, in a sense, exacerbated that loss of confidence. You remember the sort of slicing and dicing that was talked about. So we have to look out for these warning signs. Are we seeing, and we are beginning to see some elements of repackaging. You know, are we seeing excessive reliance on ratings? Well, we are beginning, I think, to see a bit of that going on. And so we have to get in there early and lift the lid on this stuff and say, look, good things can come out of all these developments, but we have to be careful because we've had these lessons in the past.